Hello, dear viewers. Welcome to another episode of Investology, where it is my job to pick the brains of some of the experts, opinion makers, and key folks in this whole area of investing, finance, and everything money. Today, we have a very, very interesting topic on our hands. Should you be investing in small cap funds? Small cap funds usually is one of the most misunderstood yet very, very interesting categories of mutual funds that there may be. And we have with us an absolute expert in this space, Harish Bihani. Harish is a senior fund manager at ICICI Prudential AMC. AMC stands for Asset Management Company, which is a mutual fund company where he manages ICICI Prudential Long-Term Equity Fund and also ICICI Prudential Smallcap Fund. He has an overall experience of over 14 years, having worked previously in prestigious organizations such as SBI Mutual Funds, Kotak Institutional Equities in varying capacities. Harish, welcome to the show.
Thanks so much, Abhilash.
Harish, let's dig right into the topic. Small cap funds. It's been in the news of late. The last one and a half years. It's, if I may say so, it's one of those hot favorite categories in mutual funds. Why is that so?
Sure. So, Abhilash, let's kind of go back to last fiscal year, April, May of 2020. COVID hit us from nowhere and market corrected sharply, and you saw small cap correcting very, very sharply. And at that point in time, there the overall outcomes was very wide in terms of the outcome that one could kind of foresee or forecast in the next 6 months, 1 year, 2 years. It was wide. People couldn't understand, what's happened. However, what we saw is that gradually things started improving. A lot of companies, whether it was large cap, mid cap, small cap companies, and these are organized companies, they started gaining market share. The What happened with COVID is that you had a disruption on multiple fronts. You had supply chain disruption globally and in India. You had unorganized disruption. You had disruption on the raw material side. And with these disruptions, the larger companies, larger in organized side, they were better prepared to kind of participate and take care of what was happening in India and globally. And they started gaining market share. As slowly and steadily they started gaining market share, there were tailwind which came in, whether it was tailwind which came from China Plus One, PLI, and a lot of small cap companies started benefiting from this particular theme. As you kind of keep uh, as many more companies started benefiting from these particular themes, we saw that some of the niche small cap companies, whether it was in the electronic sector, chemical sector, pharma sector, started doing well. And that is where investors started kind of discerning whether which are the companies which are going to incrementally participate over the next 1, 2, 3, 5, 10 years in this entire India growth journey, which will be led by some of these new age themes which are there. And a lot of small cap companies caught up, which is where you saw that from the market cap which went down to dirt lows, you started seeing a recovery, gradual recovery taking place. And as investors continue to understand and appreciate the changes that is happening in some of these sectors and companies, they started valuing these companies appropriately. And that is why you've seen the market cap rise sharply, some of these small cap companies doing exceedingly well, some of the sectors doing exceedingly well, and the overall small cap index doing exceedingly well. Within these indexes, and as a fund manager, we had identified certain themes, names, etc., which have rightly participated in this particular opportunity. And you have seen the kind of return that a lot of small cap funds have been able to deliver in the past 1 year.
Got that. So, excellent point made, Harish. So, you mentioned that you identified some of these sectors or themes that have performed well. What are those sectors or themes? Can you talk a little bit
So,
about that?
so let me give you examples. What government did as COVID hit, and there was this issue on the supply chain side, global companies started wondering, how do I make our companies more anti-fragile, more resilient? and not kind of nimble footed. Before pre-COVID, nimble footed, having a lean supply chain system, having a just in time supply chain system was the buzzword. Post-COVID world, what companies globally and India have realized is that they have to become anti-fragile, more resilient. Within this, there were themes that were emerging, whether it was a China plus one theme which was emerging in, say, a chemical sector or the pharma sector, or the entire electronics export opportunity which came up. Government also did a lot of right things to kind of ensure that India has its own share in some of these opportunities. So you would have heard of the production linked incentive scheme, which government kind of initially introduced last year, and it's taken up shape well in the electronic sector already this year. And there are many other sectors where government has proposed these particular production linked incentive scheme. So you had the electronic sector, you have, as we already spoke about, chemicals and pharma opportunity which came up. Auto is one particular sector where again government is looking at the production linked incentive opportunities. And there are many other companies which initially participated because of the tailwinds created by global supply chain disruption and global companies looking at some of the kind of impact which should happen in the companies, and how do we make ourselves more anti-fragile. The second thing which happened with COVID and the changes that happened is that uh, people started realizing that as we stay more at home, we would, we might need larger houses. We might not need houses near our offices. We would need larger houses. We also lot the top 10% of India or top 15% of India has saved a lot of money in the last 1.5 years. This together with the aspiration that we need larger houses or our own houses as we live more in house versus working in offices, the real estate sector started moving up slowly and steadily. And as real estate, which had been down and done for the last several years, started moving up slowly in the last couple of quarters, we have also seen the ancillary impact on various other sectors which is linked to the real estate sector. Whether it's cement, whether it's building materials like ply, tiles, etc. These companies, these sectors also started participating in the entire rally. And there are many other pockets. So you've seen. Then the third is export opportunities, and we can talk about this for all day long. Export opportunity came up not only on some of these production linked incentive scheme, but also on the engineering and export side, on the textile side, where once again government is working on various schemes. However, you've seen that despite these schemes, we have started seeing the benefit of higher export coming through in the engineering goods side, textile, gems and jewelry. We've seen an all-time high in recent months. So there have been various sectors, various companies that have benefited from the entire kind of changes that have happened in the last 1.5 years, and there's more to go in the coming years.
Right. So that someone has asked a related question. Which sector do you think where there are a lot of these small cap companies has the potential to become large cap in the next 10 or 15 years? Anything that comes to mind? AK
Many
asked that question.
many sectors, many companies will become large cap companies or potentially mid and large cap companies in the coming years. Say, take the simple example of a real estate companies. Real estate companies in India traditionally have been, because real estate segment has been kind of very unorganized. 90% is still unorganized in India, and the largest listed company is at this point in time somewhere around $4 billion market cap company. And there are many small niche companies with the right parentage, right lineage, that have the right focus area right now. And you and me as consumer would want to kind of partner with those particular companies and not with any ABC company whom we don't know, understand, have trust and faith in. And so that is one particular sector where you can see, companies becoming from a small cap, 2000 crore, sub 2000 crore company to a 10, 15, 20, 30,000 crore company. And the entire related field, whether it's tiles, ply, etc., all these things will keep growing as real estate keep growing in India. By the way, the other thing which would happen with some of these sectors is that the unorganized players used to benefit in these building material categories. The unorganized player used to benefit because of taxation loopholes, which are being plugged. Say for example, GST, with GST things have been plugged, etc. So the price gap which has come down, A from GST and B from other taxation angle, whether it's the corporate tax rates, etc., which have come down for the listed corporates and the organized corporate versus the other corporate. So all these will eventually benefit some of these companies. So that's one clear sector. The other would be, say, for example, the IT sector. So in IT sector, you've seen companies going up from very, very small size in terms of both in terms of the absolute revenue size, absolute market cap size. They've all started growing sharply. And the IT boom that we are seeing right now is going to last for the next 3 to 5 years, in our understanding. And if it lasts for the next 3 to 5 years, it has multiple impacts on the economy in terms of rising salary, etc., etc., and the after effects of those. And also, some of these smaller companies, niche companies, can become much, much larger. Then there are various niche companies in the small cap space, exchanges, for examples. Some of these niche broking companies which have become very large in size, but can become very, very large in size. Again, we've already spoken about API and chemicals, for example. Some of the companies over here could become very, very large in size. They have the right processes, right talent, right management quality, uh, right intent, and these are the things which are required. We talk about electronic sector. One of the largest company in this particular sector, which is in the outsourced manufacturing side, that was sub about $300 million market cap company pre-COVID, and just pre-COVID. Today, it's a $3 billion plus market cap company in 1.5 years, Abhilash. So that is the power of equities. You have to identify the right set of companies which would participate in the next 2, 3, 5, 10 years, and partner with some of those companies, and you should do fine over time. Is our firm belief.
Got that, Harish. Let's take a step back now. Multiple questions coming in as we speak. But how do you define a small cap? What is small cap? Can you talk a little bit about that?
A small cap, A is the traditional definition, which is what the regulators and AMP has classified, which is a certain market cap breakup, which is done every 6 months. So I guess right now it's closer to around little less than 10,000 crore is considered as small cap as of today.
So anything under 10,000 crores in market cap is small cap.
Technically, technically, not necessarily 10,000 crore. Technically, the top 100 companies are large cap. 101 to 250 is mid cap, and below 250 is small cap. But I'm giving you the second definition, which is the kind of average market cap which some of these companies had, based on which in the last 6 months the regulator decided that okay, these are the companies which are small cap. The first definition is constant, which is anything which is below 250 small cap as per AMFI and regulator.
Let me clarify that. So, in the stock exchange, let's say the BSE or the NSE, the first 100 companies in terms of market cap is large cap, 100 to 250 in terms of the rank of market cap is mid cap, and everything below 250 in rank of market cap is small cap. Got that? Understood. So, so before 2018, there was a lot of difference, and after 2018 the definition of small cap completely changed. Why did that happen, and can you talk a little bit about what that change was?
No, the definition hasn't changed, Abhilash. It's just to do with the fact definition in the context of the it was in the sense that the definition was kind of firmed up after SEBI recategorized. There was this recategorization of various mutual fund categories. There were multiple mutual fund categories, maybe kind of had similar portfolios or similar kind of themes, etc. The regulator kind of clarified that every particular fund will have a particular scheme, which will say a large cap. There'll be only one large cap fund in a fund house. There will be only one small cap fund in a fund house. And in that context too, they had kind of identified what will be called as large cap, mid cap, and small cap. So that was the change which was done about a couple of years back.
Understood. So I think out of all the different categories that are there, one of the reasons why small cap is very interesting as far as I'm concerned is this consists of all the newest sectors, because the emerging sectors, the sectors that are in the nascent stage. Abhinav is asking, EV as an industry, everyone is betting on it and it's new. So similarly, how do you go about identifying or selecting companies for your funds? So what are some of the things that you consider when you go looking out for uh, companies to put the money in?
Sure. I think the definition which you pointed out is, I guess, a better definition to kind of think about uh, companies which have characteristic which is small, which is similar to a small cap, or what is a small cap, by the way? Set aside the regulatory kind of definition. A company which can become very large in size is something you have identified, a baby which can become a bigger child, and finally, you do prosper and do very well as a businessman or as an entrepreneur. So you are identifying a baby which will become very, very, very big in size. That's a good definition of a small cap. So it could be, say, in the 105th stock in terms of a market cap. But in terms of the growth potential, in terms of the opportunity size, etc., etc., some of the new age themes that have come up, say for example, the food tech companies, etc., maybe if they can grow they can grow at say 30, 40, 50% for the next 10, 15, 20 years. Theoretically, they have characteristic which is similar to a small cap company. So that's one. I think it's a better definition of small cap. We also try and kind of think through, when we are trying to think through of the companies that are in the portfolio, how big can these companies become? Are these niche companies? What is the differentiation these companies have, etc.? And try and identify. In terms of the process, what we do is that we divide the entire small cap basket or the entire universe into three buckets. We call it bucket A, bucket B, and bucket C. Bucket A are companies which are typically known as quality companies, quality compounders. These are companies which, according to us, they are solving an important customer problem. They are run by entrepreneurs who are absolutely passionate, absolutely keen to kind of grow with good return on capital thresholds. We are looking at companies which are compounding its earning by 20-25% for the next 3, 5, 10 years, where return on capital is in excess of 20% at least. And they have the ability to reinvest the capital that they are generating, the return that they are generating every year, reinvest back in the business to keep growing at a very high rate for the next 3, 5, 10, 15 years. These are companies which a typically are ideally known as quality companies in market parlance. These are companies which provide overall stability to the portfolio. At any point in time in our fund, it would constitute around 40 to 50% of the portfolio, give or take. Sometimes it could be plus or minus, but the second bucket is we identify companies which we call as companies where there is at this point in time there's a P&L problem but no balance sheet problem. These are
Can you
companies
explain that? What is the P&L problem and what is the balance sheet
exactly.
problem?
So these are companies which are companies wherein maybe the sector is at a down cycle right now. However, what is happening is that within that down cycle, the promoter, the management, the team is working hard to ensure that A, they get back to recovery much faster versus when the sector gets back to recovery, A, and B, when sector recovery happens, they participate much, much better versus what's happening to the particular sector. And these are trading, and typically what happens is that market typically don't like such companies. They don't want to take early bet on such companies. We are patient investor. We get in some of these companies early. And I'm very happy that a large part of the portfolio as of today are composed of bucket B companies, which gives us a lot of visibility. So what happens is that you buy such companies at low price to earning multiple or low other valuation multiple based on the normalized earning power of the company. What is normalized earning power? Say the company is earning 50 rupees today and it's looking optically expensive based on that. However, we think that in 3 years it can do a 150 rupees earning, which means 3x earning in 3 years. And on that 3x earning, it's trading at say a 5 times multiple, 5 times PE multiple. Market at this point in time, they either, there can be multiple advantages as an investor. There could be behavioral, information, analytical. We think that behaviorally and analytically, what the work that we are doing ensure that will be able to participate in some of these bucket B companies. Well, a large part of the portfolio, as I already mentioned, is at this point in time are bucket B companies, which gives us confidence that things should overall do fine over time from a portfolio perspective. Moving to bucket C companies are companies which we call as companies which have a P&L problem and a balance sheet problem. These are companies which are known as turnaround companies, which we do not want to participate in. So we'll participate in A, we'll participate in B, we will not participate in bucket C companies. Classic examples could be, say, some airline companies today which have got a P&L problem. Why? Because people are traveling less, and they have a balance sheet problem because they have a large cost base to kind of take care of, and overall they don't have enough cash flow to support the cost base which is there right now. So they have a P&L problem and a balance sheet problem. We as investors will not participate in bucket C companies. These are the areas or companies where you make maximum mistakes. You avoid bucket C companies with P&L and balance sheet problem. You avoid bucket C companies which have got, say, a management problem or management is an issue. They have issues in the past. They might have kind of, they are at this point in time during bull market. What happens is that people kind of portray that they have changed, but zebra don't change its stripes very easily, according to our understanding. So we avoid bucket C companies which have management problem or P&L and balance sheet problem. We stick to bucket A and bucket B companies, and it's our firm belief that if you have a portfolio of 40 to 50 stocks with bucket A and bucket B companies, which where earning can compound at 20% to 25% over the next 3, 4, 5, 10 years, then overall portfolio outcome should follow. You will have some companies which won't work, some companies which will do much better versus what you had thought of, etc. And on average, you should do fine. So that is how we kind of think about our entire process.
But that's very, very interesting insight into how you go about choosing the companies in your portfolio, Harish. Related to this whole discussion that we are having, a couple of them, Manus Karia and Sego Sanyasi, are asking questions related to one theme, right? Uh, Small cap funds have had a great run in the last 1 year or so, right? And markets are at an all-time high, and many people are advising folks to not get into the market, not invest. So, what are the risks associated? For example, let's talk specifically about small cap funds, right? Is there something like a right time to enter, or buy into a small cap fund? How do you think about? How should an investor think about this?
So, our one of our gurus is Warren Buffett, and he said time in the market is more important than timing the market. And it's a very, very profound statement. People don't think about it. Why does he say that time in the market is more important than timing the market? Because a, if you are trying to time the market, you are trying to do too many, you are trying to take too many decisions. You are trying to take a decision on A, when should I enter, B, how when should I exit, how what is the right time, and there are multiple other kind of thought process. However, as investors, you have to think through on what is the kind of reason why you have entered into a particular stock. If you are into direct stock investing, if you are not a day trader or if you don't need short term gains, etc., and those are for thrill, that's fine. Somebody wants to do it, that's fine. But that does not make real money. Real money is made by buying good quality companies or good quality portfolios and sitting tight and living through some of the volatility which will come through. Think about the volatility which came through last year in April, May, March, April, May. COVID happened, everything crashed, market went down, everybody said that everything is finished, nothing is going to kind of recover. However, and as soon as market recovered to say 10,000, people said, हो गया अभी, चलो बेच देते हैं. हाँ अभी नहीं, चलो अभी नहीं डालेंगे, थोड़ा 10% गिरेगा, अभी 9,000 में डालेंगे पैसे. फिर 11 हुआ तो बोला 10 में डालेंगे, फिर 12 हुआ तो 11 में डालेंगे. So that is the problem. I do not, as a fund manager, my what we do best is to identify companies which will do well over the next 3, 5, 10 years, right? As and so what we will stick to doing is to identify those companies which will do exceedingly well. So before this particular conversation, we bought a wonderful company today. We increased allocation in that company today, and we think that it's got exceedingly great future in the coming 3, 5, 10 years based on a certain presentation which they shared publicly with all investors today. right? So that is what we will try and keep doing day in and day out versus kind of thinking through on what's the time. For an investor, they should kind of, what they should do is that they should look at their time horizon. They should think through of, okay, if I want to invest for the next 3 years, right? Small cap could be slightly risky. If I extend my time horizon to 5 years, it's much less riskier. If 10 years, look at the history of any small cap fund over a rolling 10-year period, any rolling 10-year period, and you see the returns that a small cap fund has kind of delivered versus a mid and a large cap fund. I would request everybody to do that. And you'll be able to identify that all else, despite all the noise, all the volatility, etc., you had a very decent experience both with a mid cap investing or with a small cap investing. That said, I want to qualify. We do not really want to take a call on whether markets will correct tomorrow. Markets could correct tomorrow, and it could correct very sharply tomorrow. But I'm very happy to answer on facts and what we are looking at right now, or based on which we are trying to kind of think through our companies and sectors over the next 3, 5, 10 years.
Got that, Harish. One follow up question on that, right? Small cap companies are generally the perception. I'm sure a lot of our investors might be thinking about this, are considered more risky, right, as compared to, let's say, a large cap fund. And let's say if then the market corrects, if a large cap fund falls by 2%, a small cap fund might fall by 5%, right? How does an investor think about this? Is it generally more risky investing in small cap funds? Is it a good, like, for example, Harish is asking, the last couple of weeks there has been a fall in the small cap index, uh, and there are multiple questions. Is it a good time to enter into small cap funds, right? How do you think about the whole risk aspect of it? How should an investor think about the whole risk aspect of investing in small cap funds?
So great question, Abhilash. You volatility is not risk. You know, one has to kind of keep this in his or her head that volatility is not risk. Why is small cap funds or small cap companies more volatile when they're trading in the stock markets? Because they are less liquid. Say, for example, I am invested in a small cap company today, okay? And because of certain reason, say I had a redemption today and I want to get out of that company today. And it's a bad day today. The liquidity is lower during bad days in small cap companies and small cap funds, which is the reason why it becomes slightly more volatile during market
Yeah,
downticks.
for the benefit of our audience, explain. Can you explain what is liquidity in this scenario? Let's say if I'm an investor in the market, I'm investing in mutual funds. I'm trying to sell my small cap fund. When you say there is less liquidity, what does that mean?
No, for a investor in a small cap fund, it is very easy for you to enter or exit any fund. There is no problem at all. We as mutual fund will ensure that you get your money back once you kind of do a redemption notice at any time before 3:30, right? So that is our job. As a direct investor, if I am managing a particular small cap scheme, or I'm trying to buy a small cap or sell a small cap company, when things are not in terms of when things are it's these stocks are thinly traded in some cases, not all, but some cases. Why? Because these are small companies with uh, and say the promoter would have large shareholding and the public investor would have lower shareholding, or even the public investors would have decent holding. Nobody would want to kind of buy or sell on a particular day. If you want to buy or sell, say, a HDFC bank, there are multiple buyers and sellers, and it's a large cap company, and there are thousands of crores trading every particular day. But when you and obviously you know the market cap of that particular company. But when you're trying to kind of buy or sell 1,000 crore company or a 2,000 crore company during good or bad days, it's equally difficult. So it makes during certain periods. So some retail investor in a bad market would have decided, or say you are in need of money today. You decide, I want to sell a ABC company today at any price. So you sell it, and there's no liquidity, and the stock keeps going down. Does it make the company more risky? The answer is no. It is
Yep.
just that somebody wanted to exit and nobody was there to buy at a certain price and kept getting the price down to exit on a particular day. It does not make the stock risky or the sector risky or the scheme risky. It is only on that particular day or on that particular month it will be more riskier. But if you look at over longer term horizon, you look at 1 year, 3 years, 5 years, 10 years, the longer you go, it volatility will not be risk. And as mutual fund investors, you will have no problem entering and exiting at any point in time. And these are all the headaches and hurdles that we have as managers. And you have seen that fund managers have been able to navigate such issues very well over the last 1, 3, 5, 10 years. And I'm sure they will be able to do it over time. We have various risk management criterias that we do from a sectoral perspective, stock perspective, etc., to ensure that we are ready for any liquidity event which comes up based on any investor's requirements.
Absolutely. So continuing on that thought, so how should, if I'm an investor, a regular investor who has a day job, wants to invest the money for the long term, how should I be thinking about investing in small caps? What should my allocation be as a percentage of my overall portfolio in small cap? How should I be thinking about it? Can you throw some
So
light on it?
it should depend on the time horizon that you have. It's as simple as that. Whether you are a 30-year-old or a 20-year-old or a 40-year-old, and your ability to stomach the volatility, as I said, which is associated with a small cap scheme, especially during market downturns. So you think that you are an investor who can invest for the next 5 years, and you've invested say 10 lakh rupees, and you will not take out for the next 5 years, and you will not look at markets day to day, and you are well aware that during bad markets, when market correct by 1%, small cap will go down by 2%. But you're okay because you know that your time frame is 5 years. So from point to point, your return, all else being equal, could be higher. I'm not saying large cap or mid cap will not be able to deliver that. Maybe they'll be able to do a better job. But as a fund manager in a small cap scheme, I'll try and ensure that we have a decent investor experience over the next 5, 10 years in some of those schemes. So if you think that you can stomach the volatility, you have longer time frame, please do invest and there's no problem at any point in time. Even though you would have invested at the peak, maybe your return would be, say, assume that you say that, okay, today is the peak of the market and market will go down from here on, right? Your overall returns will be lower versus what you would have thought of. Maybe you will get a single digit return. All else being equal, I don't know. I'm just kind of guessing in a 5 year time horizon, presuming it's market peak and you are investing at peak and getting down at getting exiting at bottom, all else being equal. But that's a very theoretical kind of assumption. But even if you do that, or as you kind of increase your time horizon, you will see that your return will keep kind of improving, and that's been proved both from global examples, local examples. People who thought through of timing it have been worst impacted. People who have kind of decided that, okay, this is the fund, this is the amount that I would want to invest and kind of take out after 5 years, 10 years, etc. I am fine. Say, for example, let's take my example. I look at markets day in and day out. I understand my companies day in, day out. And today I presume that market will go down 10% tomorrow. I cannot predict for sure. It's just a feel, okay, based on various behavioral characteristics. In this particular fund, I have decided to do nothing with this because I don't need this money for the next 5 years, 10 years. So why should I keep bothering about things which I don't need? My overall time horizon is 5 years, 10 years, so it's fine with me. So that is how I would kind of look at it.
Got that. Very insightful answer, Harish. But here comes a very interesting question that everyone will have in mind, right? This is typically the one question that is on top of everyone's mind when it comes to investing in mutual funds, right? A lot of customers have started investing by themselves, right? They do it themselves through our app, for example.
Hmm.
Be it, let's take the example of small caps. There are small cap funds. There are multiple small cap funds in the market now, right?
Sure.
So for investor, a regular investor, who is not like an active trader, they don't understand a lot of jargon. Sego Sannyasi is again asking, I don't understand things like IRR, CAGR, XIRR. Although all of these things are very confusing, right? This could be for any category of mutual fund, but what are some of those things that investor should look at before choosing a mutual fund? It could be in small cap funds. In this case, we are talking about small cap funds, but I'm guessing this will going to be a generic answer. So, is there a answer specific to small cap funds? You can say that. But what are some of those things that an investor should look
For a mutual fund,
for a mutual fund? Yes.
I think it's fairly simple that, again, if I have to invest my own money in any mutual fund, I would kind of look at the longevity of the fund manager. How long has he or she been managing a particular fund? What is the process like? It's not been actively asked by investors, uh, and it should be asked more often in all kind of conversation. Don't ask for returns, ask for process. If the process is right, over time outcome should follow. Is a strong belief. So every fund that has done well, according to my understanding, over the last 3, 5, 10 years, they had a very, very decent process. And process is something. What is a process? A process is something which can be repeated over time. It's not, a process which will work only in a particular season. And a process which works over time means that you have to give the fund manager at least 3 years to kind of deliver on that particular process. So look at the longevity of the fund manager, look at the process that he is talking about, look at, in case you can kind of measure that, is he true to the process? Has he kind of told you that, look, if a stock achieves a fair value or 3 years, so he's looking at 3 to 5 years, and he thinks that, even in 3 years he'll not make money, and still he's still holding some of those stocks. You should actively ask, why is he doing that, etc. So there are various parameters based on which, and it's very difficult from outside for an individual investor to discern. And which is why, you have a sound advisor like, say, your platform, or some other sound advisor who can come and kind of be a partner with some of the individual investor and the fund manager, ask right question, and kind of convey those to the individual investor that, look, this is a process which is right, and there's a longevity in the process, there's the fund manager longevity, and he kind of follows what he has been saying, and is being true to the process. And overall time, it should be fine. It's not rocket science. We are not doing rocket science. We are doing very simple stuff. We just complicate it too much, according to my understanding.
Got that. So there you go. So one, look at the longevity or the time that the specific fund manager has been managing this fund. These are data points that are available widely online and on our app. And look at the process. In this case, Harish, just to kind of talk a little bit more about the process. Earlier, you talked about the bucket A, bucket B, bucket C. Is that part of the process? Is there, or is there more to the process?
This is the most critical thing. You have, what you did is that you identified the companies that you want to buy or you want to hold. The other part of the process is that you think long term. You think over the next 3, 5, 10 years how these companies, management team, business, etc., will evolve, right? What what it does is that, what you are doing is that you're not playing momentum. You're not playing some companies which are benefited because of near term trends, etc., and buying companies which, because of near term momentum trends, etc., are trading at expensive valuation. You are separating the wheat from the chaff. You are saying that I'll hold a company which is slightly expensive, but I think CAGR for the next 3 to 5 years or 10 years, and overall outcome should follow. Or I'll buy a company which is cheap because of ABC reason, and outcome should follow. And the longer time frame kind of allows you to participate in, say, any downturn which comes in the market. So, say for example, markets have corrected, small caps have corrected in the past 15 to 20 days, right? Some of the small cap companies in our portfolio would have corrected more than or equal to what the indexes have corrected. Now, if I was excited, and was were holding some of those companies at a certain price 15 days back, and if those have corrected and I have cash in the portfolio, I should be buying more. So it should be, that is another thing that somebody should just go and check, that is he true to his process? Is he buying more of what he had earlier, or has he initiated a new position of, because of this particular correction? If he is not doing that, then there's some problem, which means that, he's taking a call on the markets, etc., He's taking calls on various other stuff, which may not prove to be correct from a long-term perspective, according to our understanding.
Got that, Harish. Thank you for that elaborate answer. Harish, we at Finity are big proponents of passive investing and index funds, right? Are there small cap index funds as well?
Abhilash, uh, my if you look at the history of index investing, especially in small caps, set aside large caps, look at index investing over the last 2, 3, 5, 10 years in small cap, and it hasn't done well. And there's a reason why it hasn't done as well as say some of the large cap index investing. It's because as a fund manager, I have to choose from any company which is below 250, as I told you, right? So I have to identify only say 40, 50 companies versus the universe is large. It's large. We could be looking at say a 300, 400, 500 companies over time, and we have to only identify 50. The index will buy everything. And so on average, some companies will do well, some companies won't do well, but companies that do well, but it's not rightly kind of position size, which means that it's not a very high part of the index. And so even if it goes up by 2x, 3x, as a index investor, you would not have made big money in a small cap index versus what you could have done in a small cap fund in case he has rightly sized those particular names. So my suggestion is that maybe if you're doing index investing, stick to some of the larger index investing. It captures it better. Uh, and if you're looking at small cap investing, you should kind of look at how it has behaved both globally and in India and why it has happened. And India is again the other thing is that index investing. I don't want to again as you're asking a barber if he needs a haircut, you need a haircut. But I'll tell you that as an active fund manager, India is a young country. As a young country, you'll have good ideas, emerging ideas, which can be sized rightly by an active fund manager. Despite all the issues which will happen with active fund management, for sure there'll be underperformance and outperformance over time. And so active fund managers have a role, much, much larger role to play in India versus index investing, in my view. Index investing obviously will kind of take shape well in India too, as it has done globally. But active investment should do exceedingly well over the next 5 years at least, in my understanding.
Got that. Harish, we are coming towards the close of the session. So, one last question for me, unless there are more questions from the audience. Uh, the market has been seeing, recovery for some time, and it is panning out very interestingly. What is your outlook towards how this recovery is happening, and how this will pan out going forward?
Sure. So, Abhilash, I'll kind of elaborate this. So please bear with me. Let's
Absolutely.
break up the economy into four parts. Economy is composed of public capex, private capex, consumption, and exports. Right? Look at public capex. What is happening with
Define public capital.
public capex? Is capex done by government, whether it's the central government or the state government. Interesting thing which has happened, especially in the last couple of months, is that the tax collection of the government has been better than estimates. Whether it's GST, whether it's certain cess, whether it's uh, custom duty, whether it's corporate tax collection is better. The central government do more public capex versus what it has done in the past. And we're seeing that trend. There are estimates done by various experts, as we call it, that kind of are suggesting that public capex could exceed by more than 1 lakh crore in this particular year.
Yeah,
Purely
just for the benefit of our audience, capex, what you mean is the capital expenditure that the government makes. The
capital.
more taxes that the government collects, they can go invest in roads, they can go invest in infrastructure, which in turn creates employment. There's a lot of
Absolutely.
purchases, the economy grows up. Yeah, got that.
Absolutely. And we move into a kind of virtuous cycle. So public capex, because of better tax collection, we think that public capex could be higher than what was estimated earlier, and it will be a big boost on multiple sides. We'll come to that. Private capex, gradually it's picking up. When we look at the capacity utilization in various sectors, whether it's the cement sector or whether it's the steel sector that has seen good profitability in recent quarters, and there you've seen announcement, etc. Slowly, a lot of the private sector companies have started announcing capex. One, PLI, which I talked about, the production linked incentive scheme. That's one particular scheme which is already being implemented in various sectors, and we are seeing a benefit of that coming through in the next 5 years. In fact, there's this strategist Neelkan Mishra of Credit Suisse. He has estimated that because of PLI alone in fiscal 27, the GDP growth rate could be higher by 1 to 1.5%. So you can see that things are moving in the right direction, both on public and private capex side. Exports. You look at the export numbers. The export numbers in July and early part of August, in the last 4 months of this particular fiscal year, it's inched up substantially. It's up in double digits, and we are seeing trends of export continuing not only in the near term but in the medium to long term because of various incentives, various changes which I spoke about in the early part of this particular conversation, supply chain changes, etc. So exports is in the right direction. By the way, IT exports, IT is a big boom. IT is in a big boom right now, and it has got multiple ripple effects through our economy. And IT job hiring has increased substantially. The Naukri job index is at an all-time high. IT salaries are kind of going through the roof. And finally, which moves into consumption, and consumption is will be determined by all the capex and all the export that we are doing. Finally, people have more money in their hand because either we have not spent too much during COVID, so we want to spend more. People are getting salary hikes across all sectors, and this is not particular to any one particular sector. It's happening all across most sectors, etc. So we are moving into a virtuous cycle, and once you move into that virtuous cycle, earnings will come through. Markets are a slave of earnings and cash flow. So when people say markets are expensive, they should realize that if the growth which is happening in the economy moves into earnings and cash flow of companies, then maybe there could be a time correction of 6 months. But finally, if earnings catch up, cash flow catches up, you're we are in for good times in coming years. So we'll all have to be patient. We think that we are in the right direction as an economy. Things are working out for India based in various kind of sectors and companies, and we should be more patient as investors, and we should have see good times ahead.
Got that. So very positive outlook overall. But one last question that kind of ties into this answer. Maybe we can tie a bow to this conversation. Neha is asking, uh, the outlook is very positive, but do you see any risks? Do you see any possibilities for a major correction for any reason at all? This is something that is on everyone's mind.
Abhilash, typically what happens is that, people are worried about various things. There are excesses globally because of central bankers kind of printing a lot of money. There are excesses in various other parts of the world. There's this liquidity sloshing around, looking at assets, etc. And some of these could kind of change. Market is trying to anticipate some of those changes. They've been trying to anticipate those for many months, many years, and things will kind of, we'll see how it evolves. uh, Thing is that risk is something, typically, market gets impacted in a significant way by risk which we can't foresee as of today. You look at any particular risk, whether it's the credit crisis risk or whether it's the COVID risk, or whether it's any other risk. So we'll have to kind of live through it. If you have bought the right companies in your portfolio, which because of some of these macro reasons, you might be able to buy more of some of these, sit tight and do well. We do not know when some of these risks, that known risks which people are talking about, will play out, or some of the unknown risks will come into play. At this point in time, we do, and as I said, that tomorrow markets might correct 10%. Nobody can forecast that. We think that we are better prepared. We are better kind of, we'll do a better job as fund managers if we are prepared to kind of participate in some of the risks that could actualize, rather than worrying too much about the risks that could come through. And that is what we try and do in day out to ensure that overall we give a decent experience to the investors who have reposed faith in us.
Wonderful. I think that one of the main things that you answered with that is, don't try to time the market. Right? Don't wait for a correction. Don't invest. And if you're a long-term investor, stay invested for the long term. Over a period of time, compounding, and the market will take care of your returns. Wonderful, Harish. I thoroughly enjoyed this conversation. It was fascinating. It was very, very insightful, and going by the comments, that is very obvious as well. Thank you so much for your time today. Any parting comments to our audience here?
No, Abhilash, I think that we overtly worry about stuff, too much about too many things. I think stick to your asset allocation strategy, and whatever you've decided, just be clear on what you have decided, and be clear that, look, this is the money which is there for trading. 1 lakh rupees, even if I lose 1 lakh rupees because something happens in the market tomorrow, I lose that 1 lakh rupees. This is the money which is there for long term. This is the money which I'll invest in mutual funds and I'll not take out for the next 5 years, 10 years. If you're clear about that particular asset allocation, you'll do fine. Even though I might underperform, that's fine. I might underperform as a fund manager by, say, a 500 bits. It will be bad, but from your return perspective, it won't be a disaster over a longer period. But it'll be a bigger disaster if you decide to do trading with a 5 lakh, 10 lakh rupees, which is a large part of your portfolio, and something bad happens in the market, and you kind of go back and don't deploy, don't keep investing for your final investment goals. That's the worst thing that you will do. So just stick to your asset allocation, segregate whatever you want to do, and you will have a very, very good good experience from the equity markets.
Thank you so much, Harish. Dear audience, I really hope you enjoyed this conversation and took away a few things and enjoyed it as much as I did. Just so that you don't miss future conversations such as this, please ensure that you subscribe to our YouTube channel. If you have any questions for us, please write to us at ask@finity.in. I'll be very happy to get the answers from Harish for anything small cap funds or anything about mutual funds in general. Thank you once again, Harish. Have a good day. Have a
Thanks.
wonderful investing journey.
You take care. Bye.
Thank you.